Hello everyone, a very good evening. Welcome to the first capsule lecture of your BRBL exam for the June 2025 exam cycle. Once you are here, please mark your presence. Let me know in the message box so that I can know who all are here. And this class is also going live on the YouTube channel. So those who have joined us from this platform, hello, good evening. So, as we have already discussed, we are going to follow this strategy for this particular week. Our exam is on 28th, so starting from today we are going to have the BRBL classes from 7 p.m. daily, 7 to 9, and then 9 to 11. Probably if we need to extend, we'll go beyond that. Today is the demo class. We'll be covering the module A today. Then tomorrow at 7 p.m., 7 to 9, we'll be practicing MCQs, case studies, all the questions, all the possible important questions from module A from 7 p.m. on YouTube. Then from 9 p.m., we are going to meet again here on the paid platform in the second lecture of our capsule batch, and we'll be starting with our module B. So let us start. We will just wait for another 2 minutes so that others can also join us. Good evening, everyone. All right. So let us start. What is going to be our strategy? We are in this batch going to revise our whole syllabus. So we'll move quickly. We will cover only the important parts, only the important topics that will definitely help us qualify our exam. All right. So this is the revision batch. Okay, and I want all of you to be active. And if you don't understand any term, you want me to repeat any concept, please let me know. So let us start. First, in our module B, we have 7 units. 7 units basically which are covered under our two acts, the Banking Regulation Act and the Reserve Bank of India Act. So the legal framework of regulation of banks, the control over organization of banks, the regulation of banking business, returns, inspections, the NBFCs, other banks like the private banks, foreign banks, and some financial sector legislative reforms. These are the units that we are going to study in our module A. A very good evening, Harish. So let us start. Okay. First, one very important section from our Banking Regulation Act which defines the banking is section 5B. It defines banking accepting for the purpose of lending or investing of deposits of money. So when we are talking about deposits of money, I hope you remember these deposits are demand deposits, which are withdrawable on demand. These deposits are accepted for the public. So these deposits are repayable on demand through check, any other mode like draft, order, otherwise. What do the banks do of these deposits? They use it for giving out loans or investing, right? So acceptance of deposits from the public and lending or investment of such deposits. These are the two activities which are performed by banks, and every banking company has to perform these two functions. Now, when we are talking about accepting these deposits, banks can also reject these deposits if the customer does not fulfill the KYC norms, they do not fulfill the certain conditions, they have to comply with the RBI guidelines, identification of the customers, monitoring of the transactions of a suspicious nature. Deposits are withdrawable by check. No other banking, any institute, no other person than a banking company can accept these deposits which are withdrawable by check. Non-banking entities accept deposits, but these are the time deposits, not the demand deposits. First important section. Then section 22 of the Banking Regulation Act, which tells us that every entity who wants to start the banking business, who wants to engage in the banking business, first they need to obtain a license from RBI. So for commencing or carrying on the business of banking, they have to apply for a license. RBI will conduct scrutiny. The RBI will make sure that the bank fulfills all the necessary terms and conditions regarding the paid up capital, all the reserves, regarding their intention to act in public interest, the directors, any person involved is not of a suspicious moral turpitude. All right, and then they will give the license. Once they get the license, they will have to use the word bank, banker, or banking as a part of its name, and no other entities used or allowed to use these terms. Any company, let's say, was in existence before the Banking Regulation Act of 1949 came into force, they also need to apply for the license within 6 months. Otherwise, they cannot continue. Right. This is section 22. So first section important one, 5B, second section 22 of the Banking Regulation Act. Then we have another important section, section 8, which talks about the prohibited business. There are some activities, certain functions which are permitted business given in our section 6. 6(1) of the Banking Regulation Act. Apart from accepting deposits, giving out loans, every kind of selling, accepting, buying of, or drawing of bills, transacting any kind of guarantee, indemnity, these are also allowed. These come under section 6. What is important to us is section 8, which tells us that banking company cannot engage directly in any trading business. They cannot undertake any trading risk. So bartering of goods directly or indirectly is prohibited. When we are talking about goods, what is the meaning of goods? It talks about the movable property. Exception: other than actionable claims, stocks, shares, money, bullion, specie. These are the exceptions. So movable property, goods. The bank cannot engage in buying and selling of these movable goods. That is prohibited. Prohibited business is given in which section? Section 8 of our Banking Regulation Act. Then banks can be of different categories in India. They can either fall under a body constituted under a special act like the RBI Act, Nabard Act, or we have the RRBs. These are constituted under a special act, or they are a company registered under the Companies Act, or a foreign company, and a cooperative society. But all of them will have to get license from RBI, right? So first we have the public sector banks other than SBI. They are either constituted under the Banking Companies Acquisition and Transfer of Undertakings Act 1970 and the Banking Companies Acquisition and Transfer of Undertakings Act 1980. Two acts are there. So all the public sector banks, nationalized banks, they will be under these two acts. Then we have SBI. Why SBI is stated separately? Because it is created under the State Bank of India Act of 1955. Now, in the beginning, there were 7 subsidiaries or associate banks of SBI. Over the time, they have been merged, right? They were constituted under the State Bank Subsidiary Banks Act of 1959, and then in 2017-18, they have been merged. We also have the regional rural banks, which are constituted under the RRBs Act. About all of these different types of banks, we are going to discuss again in detail in Unit 5, right? So RRBs are governed by the Regional Rural Banks Act of 1976. Then private sector banks or foreign banks are also allowed to operate in India. They are constituted under the Companies Act of 1956 or the Companies Act of 2013, the private sector banks. Foreign banks will be incorporated under that country's Companies Act. And obviously, again, they will have to take license from RBI. There will be stipulated paid up capital. RBI will check whether the relations between India and that country, these are positive or not, whether the foreign bank which is opening a wholly owned subsidiary in India or a branch in India, do they have a good past record or not? These things RBI will check and then it will give the license, right? So these foreign banks are also governed by the Banking Regulation Act and the RBI Act with regard to their business of banking. And then finally, we have the cooperative banks. Now, earlier, the cooperative banks were not under the control and regulation of our Banking Regulation Act or our RBI Act, but with an amendment that was made in 2020, these are also regulated. So, cooperative bank conducts the ordinary banking business. They are either under the Multi-State Cooperative Societies Act, or if they're operating in just one state, so the State Cooperative Societies Act, right? And basically, these are to reach the unbanked or underbanked sections of the society, the rural sections of the society. They encourage thrift, self help, cooperation among the rural sector, those who have limited means. So, cooperative banks are also a type. Like we said, if the cooperative bank is operating in more than one state, then the Central Act, which is the Multi-State Cooperative Societies Act, is going to apply. And if it is working in just one state, so the State Cooperative Societies Act would apply. And the banking laws application to cooperative societies. Now, when the Banking Regulation Act was initially enacted, it was the Banking Companies Act. Later on in 1965, the cooperative societies were also brought under the act, thus the name was changed. So in 1965, the Banking Companies Act, the name was changed to Banking Regulation Act. All right. So over the years, there have been a large number of problems in the cooperative sector. Thus, the Banking Regulation Amendment Act of 2020. So now, RBI has the power to regulate the cooperative banks as well. Their amalgamation, if RBI wants to appoint a director, if RBI wants to take over the management of the cooperative bank, all of these powers have given to RBI through this amendment. All right. Now, when we are talking about the Reserve Bank of India Act 1934, we know RBI is the central bank, the apex institute which regulates the banking business, but not directly. The main controls and provisions of the banking business are given under the Banking Regulation Act. RBI basically monitors those regulations. Even the licensing power is given to RBI under the Banking Regulation Act. So RBI is the apex body, the ultimate body that is allowed to print and issue currency notes, keeping of reserves with a view to securing monetary stability. RBI uses various quantitative measures, various qualitative measures, the CRR, SLR, open market operations, all of these things to control the financial sector of the economy. Although it is a free sector, but RBI regulates it, it monitors it so that any factor that could negatively impact our financial system that could be controlled. So the RBI Act deals with the constitution, powers and functions of the Reserve Bank. But RBI does not directly deal with the regulation of banking system except for section 42. Section 42 talks about the cash reserves of the scheduled banks that are to be kept with RBI. So CRR and SLR, which the banks need to maintain with our central bank. All right. In the case of inflation, CRR will be increased. In the case of deflation, CRR will be reduced. So, to maintain the monetary stability, RBI uses these reserves. Then there is a Central Board of Directors. Central Board of Directors has the responsibility of general superintendence and direction of the banking business. What is the constitution of the Central Board of Directors under RBI? A governor and not more than four deputy governors appointed by the central government, four directors nominated by the central government, 10 directors nominated by the central government, and two government officials again nominated by the central government. The constitution of this board is important. The institute has asked in the previous exams as well, which of the following are the members of the central board, or which of the following do not form part of the central board. So make sure that you remember these. In fact, all of the things that I've included in these notes are important. Only the important part is here. I have reduced many topics so that only exam specific content you can have for your revision. Then if we talk about the RBI Act, the scheduled bank, which is included in the second schedule of the RBI Act, then other important sections like the management composition of the central board, the business that RBI may transact, the business that it might not transact, all of these things are there, but they are not important for us. Okay. Next, we have our Banking Regulation Act of 1949. It was passed as the Banking Companies Act of 1949. Then the cooperative societies were included, and then the name was changed to the Banking Regulation Act of 1949 when from 1st March 1966. Why? Because it was initially applicable to the banking companies alone. Then in 1965, the cooperative banks were also brought under this act, and it has been amended from time to time. So now it relates to the primary cooperative banks, the state cooperative banks, as well as the central cooperative banks. Okay. So the provisions given in the Banking Regulation Act will be applicable to our cooperative banks as well. Then RBI also has the power of the annual financial inspection, again given in the Banking Regulation Act. So RBI makes a comprehensive risk assessment. Remember the full form, SPARK, Supervisory Program on Assessment of Risk and Capital. So RBI makes a comprehensive risk assessment under the risk-based supervision. Again, we'll be studying about it in detail in the unit 4, the returns, inspection, winding up mergers. Also, there's the depositor education and awareness fund. So those inoperative deposit accounts where there have been no operations in the accounts that are maintained with the bank, the money is left inoperative, these are transferred to this DEAF, and it is used for creating consumer awareness, distributing information by the RBI. Then, so the inoperative deposits accounts which have not been claimed or operated for a period of 10 years or more, within a period of 3 months from the expiry of 10 years, these deposits, this amount is transferred to the DEAF. So RBI also regulates the banking business. Regulation is also there in the Banking Regulation Act. So regulating of the issue of bank notes, keeping of reserves, operate the currency and credit system. Then government also in exceptional cases acts as the regulator of banks. Only in exceptional cases. This power has given to the government under section 7(1) of the RBI Act. Right? Other things, governor and the members of the central board, as we have already seen, are appointed by the central government. Government of India is also the sole shareholder of RBI. So the government has been given some powers to give directions to RBI wherever considered important in public interest. But this should be in consultation with the governor of RBI. Which section? Section 7, 1 of the RBI Act. And like we said, these powers will be used by the government only in exceptional cases. Thus, it has been utilized only once. First and the only time these powers were utilized by the government was when? In October 2018. Separate letters were sent to the RBI governor by the government on issues ranging from liquidity for the NBFCs, capital requirement for the weak banks, and lending to SMEs. 3 points. All of these 3 points are important. Only once the powers given to the central government under Section 7(1) have been utilized. When? October 2018. Then you would have studied about how RBI has the power to cancel the license of the bank. RBI also has the power to cancel the license of a payment system. If any entity is aggrieved by this decision, they can make an appeal to the central government. If RBI is removing a director from the board of the bank, they can also make an appeal to the central government. So, government also has other powers. The appellate authority in several matters. So, appeal against removal of a managerial personnel of the bank, cancellation of a banking license, refusal of certificate, suspension of operations, exemption from any of the provisions of the Banking Regulation Act. All right. So these are the powers which have been given to the central government. And as we have already discussed, cooperative bank are also now under the regulation of RBI under the Banking Regulation Act as per the amendment made in 2020. That is all from our Unit 1. Nothing else, only these sections which I have included here. You need to go through them. And other theoretical part, which is very general, right now you need not worry about it. All right. Till here, I hope everything is clear. Any doubts, any queries from the topics that we have covered so far? Any questions? Clear? All right. Okay. Now we are starting with our second unit of Module A, which is Control over Organization of Banks. As already discussed, the organization of banks is under the Banking Regulation Act and the RBI Act. First, we said under Section 22 of the Banking Regulation Act, a company requires a license from RBI for starting or carrying on the banking business. Without this license, it is prohibited. Let's say any company, any bank was in existence before this act came into force in 1949, then within 6 months from the commencement of the act, they will have to apply. And until their applications for license is accepted, they cannot continue. Okay, so it is at the discretion of the Reserve Bank. They will check whether they have sufficient ground to believe that the bank is fine, it has all the necessary conditions, then the license will be given. Even for the foreign banks, licensing of the foreign banks, they have to first give an application if they want to set up a wholly owned subsidiary or a branch in India. They must satisfy RBI that they are subject to the adequate prudential supervision in their home country. If a bank in India incorporated under the Companies Act, they should be in a position to pay its present and future depositors. They should not conduct any business which is detrimental to the interest of the present or future depositors. The public interest should be served. Similarly, when we are talking about a foreign bank, the economic and political relations between India and the respective country, the financial soundness of the foreign bank, ownership pattern, rating, international presence, government laws, all of these things will be first scrutinized by RBI and then they might give the license. If we are talking about universal banks, earlier the licensing policy of the universal banks was quite stringent, but now type on tap licensing has been started. So, recognizing the need for having an explicit policy in line with the recommendations of the Narasimham Committee, the Rangarajan Committee, banking structure in India, the way forward. This paper was launched in 2013. This was open for considerations and advice from the public, from the banks, and other institutes. Finally, the guidelines for on tap licensing of the universal banks was passed. On tap licensing means earlier some windows were open. Only during this time period, the private banks, if they want to get the license of a universal bank, only in this time the applications were accepted. Now, at any time throughout the year, they can fill up the application with RBI. All right, so these are the on tap licensing. Then the small finance banks are also registered as the public limited company. They will get the scheduled bank status once they commence their operations. Okay, when we are talking about the universal banks, so the eligibility of promoters, the fit and proper criteria, their corporate structure, minimum voting, equity capital requirements, these will be checked. For the small finance banks also, on-tap licensing has been given. What is the registration licensing requirement? Again, what is the objective of setting up the SFB will be checked. The eligibility of the promoters will be checked. What is the scope of activities, the area in which it is going to operate, the corporate governance, furnishing of the business plan. These things are there. RBI has the power to give license. RBI also has the power to cancel the license. If any bank is found to be carrying on their business in a manner which is detrimental to the public interest, which is causing harm to the financial stability or to the depositors, RBI has the power to cancel the license of the banking company. If the company ceases to carry on the banking business in India, if the company fails to comply with any of the conditions imposed, or they are doing any activity which is detrimental. All right. But obviously, first they will have to give proper reason to the banking company. The banking company will be given a chance to be heard, to show cause if there's any delay. Why is there a delay in complying with the provisions? They will be given a chance to be heard. They also have the option to appeal against this cancellation with the central government. But now the central government's decision will be final. The decision of the central government, whether RBI's decision of cancellation is correct or not, will be final. Now the banking company cannot go to any high court or the Supreme Court. Okay. Cancellation and licensing. Then approval for opening a place of business. Again, without obtaining prior permission of the RBI, no banking company will open a new place of business. All right. Otherwise, within the same city, town, or village, the location of an existing place situated in India. So, no banking company which is incorporated in India can open a new place of business without obtaining RBI's prior permission. But this place of business is, let's say, a temporary one. Then it is allowed. Temporary one means that for an exhibition or a conference, they're just opening a counter. That is a temporary place of business. For that, permission is not required. Otherwise, first they need prior permission and RBI will be required to be satisfied by an inspection, the financial conditions, all of these things will be there. Next, we have the requirement of paid up capital and reserves, again, very important topic. How much paid up capital is to be maintained by the public sector banks? What is the requirement by the foreign sector banks? Then under public sector banks also we have different categories. If they have their place of operation in these cities or these towns, the requirement is separate, right? So foreign banks, although the paid up capital term is not used, the term is used a deposit. They have to deposit and at all times keep deposited with the Reserve Bank an amount of rupees 15 lakhs. If they have a place of business in Mumbai or Kolkata or both. Directly question from this topic has been asked by the institute in the previous exam. So please remember, if a foreign bank which is incorporated outside of India but it is operating in India, they will have to maintain a deposit of rupees 15 lakhs if it has a place of business in Mumbai or Kolkata or both, then rupees 20 lakh. Otherwise, rupees 15 lakhs. Apart from this, that is, along with this deposit, 20% of the profit for each year in respect of the business transacted through the branches in India, not their overall business, but only through the branches in India. 25% of the profit, as disclosed in the profit and loss account, will also be deposited with the Reserve Bank. This is important. The securities can be deposited, it can be replaced by other unencumbered approved securities. The central government can also exempt any foreign bank from this requirement. And on cessation of the business of the foreign bank, these deposits shall form the assets of the company on which the creditors have given the first charge. All right. So if they're operating in Mumbai or Kolkata, then rupees 20 lakh deposit. Anywhere else, rupees 15 lakhs and 25% of the profit for each year. This is to be maintained by the foreign banks. If we are talking about the Indian banks, the banking companies incorporated in India, again there are different categories. If it has a place of business in more than one state, then 5 lakh rupees. And if it has any such place of business which is situated in Bombay or Calcutta, then 10 lakh rupees. Mark my words. The module A is completely theoretical things that you have to remember. But these are only the limited things. So, if it has a place of business in Bombay or Calcutta, then 10 lakh rupees. More than one state, 5 lakh rupees. All right. If let's say it has all its places of business in one state only, and none of which is situated in Bombay or Calcutta, then it is 1 lakh rupees in respect of its principal place of business and 10,000 in respect of other places. So if let's say a bank has its operation only in Uttar Pradesh, the principal place, the head office, let's say is in Lucknow, then 1 lakh rupees for Lucknow and all the other cities, any other the place of business, rupees 10,000 in the same district. And anywhere else in the state outside of the principal place of business, rupees 25,000. So there are three parts for this. All right. Operating in more than one state, 5 lakh rupees. If that state is Bombay or Calcutta, 10 lakh rupees. Operating in only one state, then for the principal place of business, rupees 1 lakh. Other places of business in the same district as the principal place of business, rupees 10,000. Outside of the principal place of business, rupees 25,000 in respect of each place of business. Then if it has all its places of business in one state, this we have already discussed. All right. So these are the paid up capital requirement. Then this very important ratio between the paid up capital, subscribed capital and the authorized capital. Please remember this point as well. The Banking Regulation Act stipulates that the subscribed capital of a banking company shall not be less than half of its authorized capital, and the paid up capital shall not be less than half of its subscribed capital. So, authorized capital, subscribed capital, paid up capital, 4 is to 2 is to 1, right? So, the subscribed capital shall not be less than half of its authorized capital. Paid up capital shall not be less than half of its subscribed capital. Remember this ratio. A is to S is to P, 4 is to 2 is to 1. If at any point the capital is increased, the requirement has to be complied within a period not exceeding 2 years as allowed by the RBI. Okay, so if let's say the authorized capital is increased from, let's say it was earlier 4, now it is 6, then this will become 3 and this will become 1.5. This has to be done within 2 years, not exceeding 2 years. This is the paid up capital, subscribed capital, and authorized capital. Then, if we talk about the shareholding in banking companies, there's no specified ceiling of a person's holding of shares, except a cap of 5% of the paid up capital, which is given under Section 12B. However, there are restrictions on the voting rights of the shareholders. So you can have as many shares as you want, but the voting rights, there's a restriction. So what is the restriction? 10%. No person holding shares in the banking company has voting rights in excess of 10% of the total voting rights of all shareholders. This is important. If, let's say, at any point this is increased, such ceiling will be increased to 26% or whatever the case may be. RBI may increase it. All right. Then what else? Transfer of shares of banking companies are also governed by the law of the Companies Act. If, let's say, a bank receives request for the transfer of shares to one party, resulting in the party owning more than 5% of the paid up capital, there are certain restrictions, there are certain instructions of RBI that have to be fulfilled. Other than that, there's no ceiling, there's no restriction. All right. Obviously, reports on shareholding has to be given. Reports on the commission, brokerage, and discount has to be given. A report regarding the particulars of shareholding of the chairman, managing director, or the chief executive officer can be called by the bank by the RBI. Right? They can also order for any other information relating to these shares. If we are talking about the commission, brokerage, and discount, which is offered on these shares by the banking company, there's a ceiling. So, payments on these account in any form should not exceed 2.5% of the price at which the shares are issued. Earlier, this debenture, this brokerage that was paid, it was linked to the paid up value of the shares. Now it is linked to the price at which the shares are issued. So the payment shall not exceed 2.5% of the price. Also, before announcing or before payment of dividend, some important conditions have to be fulfilled. The minimum prudential requirements. Proposed dividend should be payable out of the current year's net profit only. Out of the current year's net profit only, not more than that. And the bank should have the CRAR of at least 9% and their net NPA should be less than 7%. So if their risk based assessment comes out to be less than 9% or their net NPA comes out to be more than 7%, they are not allowed to declare dividends. So first they will have to maintain this. Certain flexibility is given by RBI. If let's say the CRAR is at least 9%, it would be eligible to declare dividend, but The net NPA should be less than 5%. All right, these things are also there. So this is the declaration of dividend. So if they do not meet the above CRAR norm, but they have at least 9% and their net NPA is less than 5%, then also they're allowed to declare dividends. These dividends will be paid out of the current year's net profit only. All right. Okay. Then, if any banking company wants to form a subsidiary for undertaking any business which is permissible for carrying out business of banking exclusively outside of India, or undertaking any other business with the prior approval of central government, obviously they will first have to apply for a license with RBI. This is to prevent banks for carrying on any trading activities, right? So they can form subsidiaries, but again, only these subsidiaries will be allowed to engage in the permitted business, not in the prohibited business as given in the section 8. Banks are also allowed to have shareholding in other companies. Again, there's also a ceiling on the shareholding in the companies other than subsidiaries. So the holding of shares by a banking company as a pledgee, as a mortgagee, absolute owner should not exceed 30%. Should not exceed 30% of the paid up share capital. Right? Also, holding of shares in any company in which the managing director is substantially interested is prohibited. Right? So if the managing director is the owner of a company, in that company the bank cannot have shares. So I hope this is clear. All right. And their shareholding also should not exceed 30%. What else do we have? Then the board of directors qualification, at least 51% of the total number of the directors should have special knowledge with respect to accountancy, agriculture, rural economy. This is obvious, but we will remember at least 51%. So the number of directors on the board of the banking company, more than 5, at least 51% should have prior experience and special knowledge in these areas, plus at least 2 should have special knowledge or practical experience in agriculture and rural economy or cooperation or small scale industry. That is, they have worked in the rural banking segment, in the rural economy, or in a cooperative bank or a small scale industry. So the directors, 51% special knowledge in accountancy, agriculture, rural economy, at least 2 should have special knowledge of the rural economy or the small scale industries, right? Period of office not more than 8 years, reconstitution of board, qualification of the whole time chairman, managing director, all of these things are the same. Then there are also some restrictions on employment which are very general. A person who has been adjudicated insolvent or has been suspended payment, a person who has been convicted by a criminal court, all of these are not allowed to be appointed as directors. So, yes, we are done with Unit 2 as well. All right. What else? On the board of directors, the directors having substantial interest, they shall not have a substantial interest or they should not be connected as an employee in any other company which carries on trade. Right? These things are very obvious. We already know. Then, if we talk about the whole time, part time chairman or the managing director, if any person is appointed on the whole time basis, they're interested with the entire affairs of the bank, the day to day business, managing all the affairs. If they're appointed on a part time basis, then only for certain conditions with the prior approval of RBI, only for certain purpose they will be appointed. And in the absence of a chairman, the management of the whole of the affairs will be entrusted to the managing director. So these are the three types. Whole time will be given the responsibility of the entire affairs of the bank. Part-time chairman only with certain responsibilities. Managing director, they will step in the shoes of the whole-time director if the chairman is absent. Then we also have the Financial Services Institution Bureau, which was constituted from July 1, 2022. Why? We know that the central government has the power, or the bank, when they're appointing these directors. So a list is to be prepared. So for the purpose of recommending persons for the appointment as whole-time directors, non-executive persons, this responsibility has been given to the Financial Services Institution Bureau. Prior to this, there was the Banks Board Bureau, which has been replaced by this bureau, and the secretariat comprises of the secretary and four other officers. Right. So we are done with Unit 2, and now we are going to start with our Unit 3, which is the regulation of banking business. Any doubts, any queries, any questions from the Unit 2, or is everything clear? No, not important. From your module A, only questions covering the important sections are mostly asked. Term, requirement, these things are not there. All right? Okay. All right. So let us start with our Unit 3. Unit 3 is the regulation of banking business. We already know, under the banking regulation, the power to issue direction has been given to RBI under Section 21 and under Section 35A of the Act, right? Section 21 gives the power to RBI to regulate the advances by the banking business, where giving loans is restricted or where the loans are easily to be given. Then Section 35A talks about the regulating of rate of interest, other terms and conditions. Any direction which is given by RBI will be binding on the bank, right? It doesn't matter whether the direction states that it is a statutory direction or not, even if they do not specify to any statutory provision, then also it is binding. The bank will have to follow those instructions. RBI can also give caution, or RBI can prohibit the banking companies in performing any activity. All right. Then we have acceptance of deposit. We already know banks are allowed to accept the different types of deposit: time deposit, demand deposit, recurring deposits are also there, right? There are, for the acceptance of deposit, certain restrictions, like to the directors who have a substantial interest, they are not allowed, or some conditions are there that we'll be discussing. First, on the returns on unclaimed deposit. Banks have to file a return every year on their unclaimed deposit within 30 days of end of the each calendar year, in the manner whichever is prescribed, which will cover all the deposits non operated for 10 years. We have discussed it previously also. The return will be filed, and then these deposits will be transferred to the Depositor Education and Awareness Fund within a period of 3 months from the expiry of the 10 years. This will be used by RBI for carrying out information, giving out booklets, or any consumer awareness. All right. So all the inoperative accounts, savings bank, fixed deposit, cumulative, recurring, current deposit, they will be transferred. Then if we talk about nomination, RBI also regulates the nomination. A depositor, they can nominate one person. This nominee would be the person, they will have the rights of the depositor after their death. Nomination can be varied or it can be cancelled at any time by the depositors. If the nominee is a minor, we also know appointment of a person who is going to receive the deposit amount on the death of the depositor on behalf of the minor. In the cooperative banks also, these norms are the same. If we are talking about articles that are kept in the safe custody or safety lockers, again there are separate sections. Any person who leaves any articles in the safe custody with a banking company, they can also nominate one person to receive the articles, right? So the bank will exercise due care, they will make diligent effort, and they will make clear to the survivors or the nominees without opening. If let's say any package is sealed, they will hand over the packets. Then, yes, question answers from tomorrow at 7 p.m. Today we'll try to cover the module A. Then on YouTube, we'll be having the marathon in which we'll be discussing all of these MCQs from 7 to 9 p.m. That will be on YouTube. All right? Hmm. Okay, now this is important. We were discussing, right, the restrictions on loans and advances. No banking company shall grant loans or advances on the security of its own shares. Okay, no person can keep the bank's own shares as security and take a loan. The bank is also prohibited from entering into commitment for granting any loans on or on behalf of its directors, where the director is, let's say, interested as a partner, manager in any firm or any company in which the director is holding a substantial interest. They are the director, manager, managing agent. There also, to those companies and firms also, the bank is not allowed to give any loans and advances. These restrictions are important. All right. First, the banking company will not grant loans on security of its own shares, and they cannot give out loans to those firms or companies where the directors are interested. So these are the restrictions on loans and advances. Then earlier, the interest rates were controlled by RBI. Fixed interest rates were allowed to be offered on deposit. But now, RBI has given power to the banks. They can decide their own interest rate. However, the maximum and minimum and certain other stipulations have been given by RBI. Right? So, the directions are issued by the powers vested in the Reserve Bank under Section 35A of the Banking Regulation Act. What is important here, the scheduled commercial banks and the SFBs are allowed to offer differential rate of interest on term deposits on the basis of tenor and quantum for a single deposit of 2 crore and above. However, if any deposit is accepted, any two deposits are accepted on the same day of the same value, the interest that will be offered will be same. Their differentiation cannot be followed. All right. So all the single term deposits of more than 2 crores and above, there the banks can offer differential rates. The regional rural banks, they're allowed to offer the differential rates of term deposits of rupees 15 lakhs and above. Now, how are the banks going to decide the interest rate? Earlier, there was the BPLR system, which was introduced in 2003, but it was replaced because the original objective of bringing transparency was not followed. The banks could lend below the BPLR also. So the BPLR was replaced by the Base rate system. When? In 2010. So we will remember 2003, the BPLR system was followed. Then it was replaced by the base rate system in 2010. The base rate shall include all those elements of the lending rates which are common across all categories. Then the base rate was also replaced. It was replaced by the MCLR, right? MCLR, the marginal cost of funds based lending rate. The bank cannot grant any loan below that rate except in certain cases permitted by RBI. How do we determine the MCLR? We will include the current cost of funds in contrast to the base rate. Base rate was governed by the average cost of funds, but MCLR is governed by the current cost of funds, right? So it is an improved version of the base rate. It will comprise of what? It will comprise of the marginal cost of funds, the negative carry on account of our CRR, operating costs, as well as the tenor premium. It is a risk based approach to determine the final lending rate. So the marginal cost takes into account the repo rate, which was not considered in the base rate. So this is also an improvement. The fixed rate loans up to 3 years will be priced with reference to the MCLR. What all is included? This is important. The MCLR is going to comprise of the marginal cost of funds, the negative carry on account of CRR. What is the meaning? How do we calculate it? Not important. Just remember these points. The marginal cost of funds, negative carry on account of CRR, the operating costs of the loan product, and the tenor premium. The tenor costs which arise from the loan commitments with the longer tenor. All right, so these four things will be included in the MCLR. So how do we differentiate between MCLR and base rate? MCLR is determined by the current cost of fund. Base rate is governed by the average cost. MCLR also considers the tenor premium. Base rate doesn't. MCLR is determined by considering the deposit rates, repo rates, and the cost of maintaining the CRR. Base rate ignored it. It is governed by the operating expenses. And one very important point, that MCLR takes into account the repo rate. Base rate does not. Right? So this was there. But then in 2018-19, the external benchmark based lending was introduced. So in the financial year 2018-19, under the statement on developmental and regulatory policies, now the banks, they can base their lending rates on any external benchmark. All right, so all the new floating rate personal or retail loans, banks are free to offer any such external benchmark linked loans to the other types of borrowers as well, right? They're also free to decide the spread over the external benchmark. So, which external benchmarks are allowed? The Reserve Bank of India policy repo rate, the Government of India 3 months Treasury bill, the Government of India 6 months Treasury bill, or any other benchmark market rate published by the FBIL. Very important. So the difference between base rate and MCLR, that is important. And then which external benchmark is allowed. So these four are there. The Reserve Bank of India policy repo rate, Government of India 3 months Treasury bill, Government of India 6 months Treasury bill, and any other benchmark which is given by the FBIL. The banks are free to offer such external benchmark to any other type of borrowers, but however, they must adopt a uniform external benchmark within a loan category. So if the loan category is a home loan, all the home loans will be offered based on one external benchmark. If it is, let's say, any personal loan, or if it is an education loan, so the category, the benchmark will be same. There the bank cannot differentiate. So they will select one benchmark and they will base their lending rates based on that. All right. Then regarding maintenance of the cash reserve ratio, the reserve funds, RBI creates the reserve fund. Every banking company has to maintain the CRR and the SLR. There is different provisions for the scheduled banks. So if we are talking about the quantum of the cash reserve required to be maintained by a scheduled bank will be an average daily balance, a percentage of the total demand and time liabilities. When I'm saying CRR, relate C with the central bank. The CRR has to be maintained with central bank, which is RBI. When I'm saying SLR, the statutory liquidity ratio, then relate S with self and liquidate. Liquidity ratio means liquid assets which the bank has to maintain with itself. So CRR with RBI, SLR with itself. So RBI from time to time to secure the monetary stability will determine the CRR. Minimum 3% if the country is facing inflationary situation, RBI will increase the CRR. Increasing these reserve funds mean now the bank will have to maintain more funds and their lending powers will reduce. If the country is under deflationary powers, it wants to increase the purchasing capacity of the public, RBI is going to decrease the CRR or the SLR. So the banks will have to maintain lower funds and they can give out more loans. All right. So to maintain the monetary stability, RBI stipulates the reserve rates in its bi-monthly policy which it releases. Okay. The maintenance of CRR also has to be reported to RBI. Form A, which is the return for the scheduled commercial banks, including RRBs, SFBs, payment banks, and LABs. Form B is for the scheduled cooperative banks. So separate forms are there for separate banks. They will maintain the CRR if they are at any point unable to maintain the CRR. RBI also imposes penalty. So this is important that they maintain it. The return has to be submitted to RBI on each alternate Friday. Fortnightly returns by the reason of geographical position. If it is impractical, RBI may permit a presentation of provisional return fortnightly and a final return within 20 days. These things are there, but we will remember only this point. This return has to be at the close of business on each alternate Friday. This one point we are going to remember. What about the non-scheduled banks? They are also required to maintain the cash reserve in case of the banking companies which are not scheduled by the banks under section 18. The cash reserve need not maintained with the RBI. It may be with the bank itself or in a current account with the RBI by the way of net balance. All right. So they do have to maintain the cash reserve, but it is not necessary that they maintain it with the Reserve Bank. They can keep it with itself or with a current account with RBI or a net balance in any manner. The balance maintained should not be less than 3% of the demand and time liabilities, again, as on the last Friday of the second preceding fortnight. This is regarding the cash reserve ratio, scheduled banks and non-scheduled banks. Similarly, banks are also required to maintain the statutory liquidity ratio. All right. Hmm. So they have to maintain a percentage of their net demand and time liabilities as assets in India. Again, The statutory liquidity ratio, a minimum requirement of 25% is also prescribed by RBI. Returns also have to be maintained, but the return on the SLR will be monthly return submitted to RBI by every banking company. Maintenance of SLR will be reported as per the requirements not later than 20 days from the end of the month. So, although now you might feel that there is too much to remember, but this is only there in Module A because Module A is completely theoretical. There are a lot of things that you need to keep in mind. If it is possible to remember these things, well and good. If not, then just remember those which I'm saying are absolutely important. All right. So, yes, the banks will also have to maintain the SLR and they will have to file a return not later than 20 days from the end of the month to which it relates. Separate forms are there. Form 8 for the scheduled commercial banks, RRBs, SFBs, payment banks, LABs. Form 1 return for the SLR of the cooperative banks. Penalty is also there. The banking company is liable to pay the Reserve Bank penal interest at the rate of 3% if they are unable to report on the reserves maintained, if they're unable to maintain the reserve. All right. Another important point, if we are talking about the RRBs, the regional rural banks, talking about the assets that they maintain in India, they have to submit the report to Nabard because Nabard is the apex institutions for the RRBs. All right, Unit 3 done. Any doubts, any queries, any questions from the Unit 3? Any questions? Clear? Great. Okay. Now let us start with our Unit 4, which is the returns, inspections, winding up, mergers, and acquisition. All the banks, they need to maintain annual accounts, they have to maintain their balance sheet, and they have to submit returns to RBI. RBI also has power to conduct inspection, special inspection, scrutiny, regular inspection. So all the banks whose shares are listed with stock exchanges, they're required to publish their unaudited quarterly returns as per the format prescribed by SEBI to the RBI. The balance sheet and profit and loss account of the banking companies incorporated in India, they have to sign by the manager. All of these things are there. Okay. So if we are talking about submission to RBI, every banking company has to submit 3 copies of its balance sheet, profit and loss account to RBI within 3 months of the end of the period to which they relate. Within 3 months, 3 copies of balance sheet and profit and loss account have to be submitted to RBI. They also have to furnish accounts and balance sheet to the registrar. Again, 3 copies of the accounts, balance sheet, and auditor's report to be submitted to RBI. Don't worry about these sections. These sections are not important. Just remember. All right. 3 copies of the balance sheet and profit and loss account to RBI, and the accounts and balance sheet have also to be furnished to the registrar of companies. If we are talking about audit and auditors, powers and functions of the auditors will be decided by RBI, whether or not which information will be required, if returns from branches are inadequate, if the profit or loss account are not showing a true picture of the profit, these audits are required. RBI also has the power to conduct a special audit, which is important and has been asked by the institute. So, if RBI is of the opinion that special audit is necessary in the public interest or in the interest of the banking company or its depositors. Then they will qualify a duly qualified auditor. RBI is going to appoint a duly qualified auditor. They will conduct the special audit. When RBI is giving these directions are binding on the auditor of the banking company, and they will have to give a report to the Reserve Bank. Also, they will give a report to the banking company. All the expenses in relation to the special audit will be borne by the banking company, not by RBI. So the costs incurred, expenses incurred will be the responsibility of the banking company. Then inspection, we have already discussed. Return on liquid asset, monthly returns, return of assets in India, return of unclaimed deposits, these are already there. If we are talking about special audit, inspection, and scrutiny, special audit we have already discussed, right? Then we have inspections. RBI conducts the annual financial inspection of the banking companies under Section 35. Spark, in the very beginning that we discussed, a risk-based supervision through the supervisory program on assessment of risk and capital. This is Spark. And then a risk assessment report will be prepared. RBI can conduct any other inspection at any time. They can conduct the inspection of the books and accounts of the company, and a copy of the inspection should be given to the banking company also. Okay. Apart from it, the government can also order an inspection of the banking company. Here, when the government is ordering, then the copy of the report has to be sent to them mandatorily, and it will be sent at the option of RBI in any other inspection. So if the government is ordering the inspection, the report will be prepared and copy will be sent to the government. In other cases where normal inspections are conducted, there RBI has the option whether they want to give the copy to the government or not. All right. Government will obviously give an opportunity for the banking company to make a representation. They can cancel or modify such order. These powers are given. If we are talking about scrutiny, so again under the same section, section 35, RBI can cause a scrutiny to be made of any one or more of the officers, the affairs of the banking company, its books and accounts. If any circumstance or conditions comes to its notice that an adverse action is being taken, RBI can conduct the scrutiny. All right. Then we have the Department of Banking Supervision. We also have the Department of Non-Banking Supervision. A board for financial supervision was set up with the objective of ensuring dedicated and integrated supervision over the credit institute. This was done when in 1994. Then in 1997, it was bifurcated, it was divided. Department of Banking Supervision and the Department of Non-Banking Supervision. And then later on, the Department of Cooperative Bank Supervision was also set up. So we had three departments. Now, in 2019, all of them have been merged again into a unified Department of Supervision. All right, so earlier there were three: Department of Banking Supervision, Non-Banking Supervision, and the Cooperative Bank Supervision. In 2019, they have been merged and a uniform department for the supervision has been set up. If we are talking about the constitution and composition, governor of RBI will be the chairperson, deputy governors will be there, four directors from the Central Board of Reserve Bank will be there. Functions: fine tuning the supervisory process, introduction of supervisory rating system, better monitoring enforcement of the framework. Meeting: the board is required to meet normally once every month, and quorum means the minimum number of members that should be there to conduct the meeting will be the chairman or the vice chairman, Three members. Three members of whom one shall be the chairman or the vice chairman. Now, Daksh portal has been launched in 2022. It is a web-based end-to-end workflow. So it is online, internet-based. So on the clock, 24/7, RBI can conduct the supervision through the Daksh portal. So anytime, anywhere, secure access. Then if we talk about the acquisition of undertakings, we know about mergers, we know about amalgamation. So government of India can acquire the undertakings of banking companies. This will be known as what? Nationalization. So undertaking can mean an entire organization which will be taken over by the government. If it is, let's say, the company is being managed in a manner which is detrimental to the interest of the depositors, or if the acquisition is actually in favor of the interest of the depositors, the power to make scheme is given to the central government. All right. If the banking company has on one or more occasions failed to comply with the directions, or it is the conduction of the business of the banking company is detrimental to the interest of the depositors, they can acquire the undertaking. But obviously, after consultation with RBI, they will acquire the undertaking. They can themselves, the central government can maintain the undertaking now, or they can give it to another banking company. So, all the assets and liabilities of the acquired bank will now transferred to and will vest in the central government. The central government also has the power to order the vesting of the undertaking of the acquired bank to any other company or corporation. So now the transferee bank will take over the acquired assets and liabilities of the transferor bank. So either the the central government will themselves take over control, or they will pass on the assets and liabilities to another bank. Power to make scheme is given to the central government in consultation with RBI. So all the matters related to the property, assets, liabilities, service of employees, terms and conditions will be notified. What about compensation to shareholders? Now the shareholders might decide whether they want to continue with the shares in the acquired bank or they want to redeem their shares. So every person who immediately before the appointed day means when it is acquired, is registered as a holder of shares when the acquired bank is a banking company incorporated outside India, it shall be given by the central government the compensation in respect of the transfer of the undertaking. So every shareholder has a right to receive compensation if they are holding shares in the acquired bank. All right. Also, if they are aggrieved by the compensation that they are receiving, they have the right to make an appeal for which a tribunal will be set up. This is the acquisition of the undertakings. Amalgamation can also be ordered. Voluntary amalgamation, a banking company may be amalgamated with another banking company. Again, a scheme will be prepared. It will be placed before the shareholders of the two companies separately. It has to be passed by a majority of the members, two-thirds in the value of the shareholders. Any shareholder who is voting against the amalgamation, they have the right to claim the value of their shares. All right, this is voluntary amalgamation. Amalgamation can also be ordered by the government, right? Again, in consultation with RBI. Moratorium and amalgamation is also there. The Reserve Bank is authorized to apply to the central government for an order of moratorium when there is a good reason to do so. And the central government may pass an order that, okay, we will commence the action or the proceeding against the banking company, or we will put a stay on it, right? So if RBI feels that if time is given to the banking company, they can comply with the orders, they can come back to the fit and proper criteria, the moratorium shall be given, otherwise not. Okay. If we are talking about winding up means cessation of the business, closing down of the banking company. So if the banking company is temporarily unable to meet its obligations, they may themselves refer to the High Court for the staying of the commencement. If the government is saying that we are going to wind up the bank, and the bank says that if I'm given certain time, I will be able to overcome these temporary hurdles, then the stay can be there. Such stay will be subject to the terms and conditions imposed by the High Court. If within the stay, the bank is unable to correct their behavior, the winding up will be done. Winding up can also be done by the High Court if the banking company is unable to pay debts or the application has been made by the Reserve Bank. Central government can also give the order of the winding up on consideration of the report of inspection or scrutiny. Voluntary winding up means now the banking company itself is filing an application with the RBI or the High Court that we want to shut down our business. But no such winding up will be permissible unless the Reserve Bank certifies that the bank will not be able to pay in full its debts as they occur. And also, not just because the bank wants to conduct any unlawful business, they just want to take the money of the depositors and leave. To make sure that actually the banking company requires the winding up, RBI will conduct its inspection. All right. So this is regarding the winding up. And then we have the penalties. Penalties are imposed under the RBI Act as well as the Banking Regulation Act. If the banking companies fail to comply with the regulations, penalty of the violation of the act. If let's say they're unable to make applications, furnish returns or statements, what is the penalty? Failure to produce any books, accounts or documents or statements or information. Rupees 1 lakh for each offense. This is the penalty under RBI Act. So in the RBI Act, we studied what reports have to be furnished, what returns have to be filed. If the bank is unable to furnish this information or they are giving wrong information, 1 lakh penalty will be imposed. If it is a continuing offense, then a fine of rupees 5,000 for each day when the offense continues. Every officer also who was responsible for the conduct of the company's business will be deemed guilty. Penalty under the Banking Regulation Act. Any false statement, if willfully made, will be punishable. The punishment here is a lot more. 1 crore rupees fine and 3 years imprisonment. This is if any officer is giving wrong information. If they are failing to produce any books, then a fine which may extend to 20 lakhs. And for every day where the offense continues, rupees 50,000 will be the fine. Right? Every officer also who was involved in the contravention will be liable. They will be deemed guilty. A fine will be imposed on the officers as well. Okay? So these penalties are imposed under the two acts, the RBI Act and the Banking Regulation Act. And we are done with Unit 4. Any doubts, any queries, any questions? Or is everything clear? Any questions? Yes. One doubt, please ask. Okay, am I audible now? Hmm. So if any section of the Banking Regulation Act is contravened, if they are unable to produce any books which are required under the Banking Regulation Act, then the penalty will be according to the Banking Regulation Act. If the bank is contravening on any provisions of the RBI Act, then the fine will be according to the RBI Act. So it depends. All right? It depends on the offense that is carried out. All right? Okay. Hmm. Now let us start with the Unit 5. Unit 5 is basically we'll be discussing about the banking structure in India, the different types of banks, the laws that govern the banks. First, we have the State Bank of India. As already discussed in the Unit 1 also, State Bank of India was established under the State Bank of India Act of 1955. Basically, it acts as the agent of RBI. It is a body corporate. It means it has perpetual succession. Even if the directors they leave, the SBI will still continue. This is the meaning of perpetual succession, right? Majority of rights are held by the government of India. Now it is a complete holding of RBI. The complete holding of SBI is now acquired by the central government, not RBI but SBI. Management, it has the central office in Mumbai. Local offices are also there in Mumbai, Kolkata, any other places as decided by the government. No shareholder other than the government of India can exercise voting right above 10%. Okay. Then regarding the business of the state bank, it acts as the agent of Reserve Bank where it has a branch. Accounts and audit, the state bank has to close its books and balance accounts each year as on 31st of March. Within 3 months of the closing date, they will have to furnish the report to the central government and the RBI. Its balance sheet and profit and loss account, together with the auditor's report and a report by the central board. So, accounts and audits. Okay, under this, we will remember these 2 points. They will close its books and balance account as on 31st of March each year, and they will submit or furnish their reports to the central government and RBI, right? When we are talking about this auditor's report, audit will be conducted by any person who is duly qualified, but no director, member of the local board, or local committee will be eligible to be the auditor. This is also important. All right. Then RBI, in the beginning, there were seven subsidiaries of the SBI which have been now merged with it. There was the State Bank of Saurashtra, State Bank of Indore, which were merged in 1955. Then the other five associate banks and the Bharat Mahila Bank have been merged with SBI in 2017. The five banks were the State Bank of Bikaner and Jaipur, State Bank of Hyderabad, State Bank of Travancore, Mysore, and Patiala. So now only SBI exists. All the five subsidiaries have been merged in 2017. This is the only information that you need to remember about SBI. Then, if we talk about the RRBs, the regional rural banks, regionally based, rural oriented, engaged in commercial banking, set up first in 1975 under the RRB Ordinance, which was later on replaced by the RRB Act in 1976. Right? Each RRB will be promoted by a sponsor bank. It is sponsored and it holds 35% of the issued capital. Central government holds 50% and the remaining 15% by the state government. All right. Remember this holding. We said 35% will be by the sponsor bank, then 50% will be by the central government, and remaining will be with the state government holding of the issued capital. The management of the affairs of the RRB will vest with the board of directors. They will have to function on the business principle with regard to the public interest. What is the business of regional rural banks? Mainly giving out loans and advances to the small and marginal farmers, the agricultural laborers, agricultural marketing society. Again, if we talk about the accounts and audits on 31st March, they will have to close their balance, close their accounts, balance in their accounts. Auditors will be appointed as per the approval of the central government, qualified to be an auditor of the RRB. They will report on the working of the bank and it will be laid before the parliament, right? And then sponsor bank is empowered to monitor the progress of the RRB by inspection, internal audit, scrutiny, amalgamation. Many RRBs have been amalgamated because central government has given the order. So two or more RRBs may be amalgamated by the central government. All the terms and conditions of the amalgamation, the scheme, everything will be governed by the central government. Presently, we have 43 RRBs, and there are further plans to amalgamate even more RRBs. So, in 2012, 13, 25 RRBs were amalgamated into 10. Then in 2016, further the number of RRBs was reduced to 56. Presently, we have 43. All right. Why? To minimize their overhead expenses, optimize the use of technology, enhance their capital base and the area of operation. Other public sector banks other than the State Bank of India, we have already studied about them. These are called nationalized banks, came into existence under the two acts, the Banking Companies Acquisition and Transfer of Undertakings Act of 1970 and the Act of 1980. These two are known as the Bank Nationalization Acts. In the beginning, the six banks were nationalized, 14 banks were later on nationalized. These acts we already know. So, under these two acts, the other public sector banks have been created. If we talk about the control and management, there is a board which is vested the general superintendent's directions and management, and these schemes have to be also approved by the parliament. Then, for the superintendent's management powers have also been given to RBI as well as the central government, as we have discussed in the unit 1. These are the schemes for management: the Nationalized Banks Management and Miscellaneous Provision Scheme of 1970 and the Nationalized Banks Management and Miscellaneous Provisions Scheme of 1980. What all is given in these schemes? The constitution of the board of directors that we have discussed. 51% of the board of directors will have specialized knowledge. Two of them, particularly in rural economy, rural banking, cooperative banking, or the small and medium enterprises. Managing director, what is the meaning of that? Term of office, disqualifications. All of these things will be given in these schemes. Other than the private sector banks, we also have the other than the public sector banks, we also have the private sector banks. Private sector banks will be incorporated under the Companies Act of 1956 or the amended 2013 Act. There are the old private sector banks, this is important, which came into existence before 1968, and the new generation private sector banks which were incorporated after the 1990s in the LPG reforms. As of now, there are 21 private sector banks. In your book, the name of the private sector banks, their location, head office is also given, but it is not important for us. Then we have the local area banks in 1996. the decision was taken for the establishment of the LABs in the private sector. The minimum startup capital would be 5 crore. It was also decided that the non-resident Indians could also contribute to the equity of the bank, but not exceeding 40% of the capital of the bank. So, as the name suggests, the LABs will operate in a restricted area, in the local area. All right. Then, as of now, there are only two local area banks in existence. The Coastal Local Area Bank Limited, established in 1999, and the Krishna Bhim Samriddhi Local Area Bank Limited, established in 2011. The area of their operation, head office, again not important, just remember these two names. There are two local area banks. Cooperative banks also we have already discussed in our first unit. If it operates in one state, the State Cooperative Societies Act will apply. If it operates in more than one state, so the central law or the Multi-State Cooperative Societies Act will apply. Again, earlier it is a cooperative society, they will apply for the license with RBI and they can operate as a cooperative bank. Okay, so a primary cooperative bank is a cooperative society which has to satisfy the primary object or the principal business should be the transaction of banking business. Now they cannot operate in the direct or indirect trading of goods. Their paid up share capital and reserves should not be less than rupees 1 lakh, and bylaws do not permit the admission of any other cooperative society as a member of the bank. Okay. Then we have differentiated banks. The meaning of differentiated banks, their business, their function, their role of operation will be limited to some particular area. So, in generality, we can think that local area banks or RRBs, these are also differentiated banks only because they're working in a particular area, they're catering to a particular segment of the society, right? So the differentiated banks, they may be defined as those that offer a limited range of services or product, or they function under a different regulatory dispensation. RRBs and LABs are also considered as differentiated banks. Remember this name. The committee headed by Shri Nachiket More Committee. This committee came up with two broad designs of the banking system in the country. We have the horizontally differentiated banking system and the vertically differentiated banking system, particularly for the differentiated banks. In the horizontal bank, it will remain a full service bank. All the services pertaining to payments, deposit, credit, everything is offered. But in the vertically differentiated model, bank is going to specialize in one or more type of service. All right, so the differentiated banks are working on the vertical model. Under the differentiated banks, we have the SFBs, the small finance banks. We also have the payment banks. Who are the SFBs? These are created, these are private sector banks operating or setting up the SFBs by the provision to act as saving vehicles to supply credit to the small business units, small and marginal farmers, micro and small industries, unorganized sector. Who are the eligible promoters? SFBs are set up with promoters or sponsors, resident individuals who have 10 years of experience in banking. They can set up SFB. NBFCs, MFIs, LABs, which are again owned and controlled by residents, can also opt to convert into SFB. The promoters should be of a fit and proper criteria, right? Similarly, if we are talking about payment banks are also differentiated banks. All right, the eligible promoters can be a prepaid payment instrument. Other entities like NBFCs, corporate business correspondent, mobile telephone companies, they will accept deposit. They can issue ATM or debit card, however, they cannot issue credit card. Remittance services, banking correspondent, all of these activities are permitted to the payment banks. And are we done with the? Yes. So we are done with our Unit 5. Unit 5 is not that important. Just the acts, the basic things about the different types of banks, these are discussed. Now we are going to start with our Unit 6, which is focused on the non-banking financial companies. Any questions still here from our Unit 5? Just go through the notes and that will be enough. Any questions, any queries? All right. So now let us start with the NBFC. There are too many things to remember. That is why we are just going through the module A. I'm telling you the things that you need to remember. And starting from module B, as you already know, that is more conceptual. Okay. So NBFCs. NBFC is a company registered under the Companies Act. Which module is more lengthy, ma'am, and more important? Module A is on the last of our priority list. Module B, C, and D are important. We have we'll be covering these starting from tomorrow, and these are acts, so that would be more interesting. You need not mug up things. Module A is a bit rote learning based. Okay, module A is only a bit boring, a bit lengthy, but module B, C, and D, as we already know, are interesting. Okay. So NBFCs, it is a company registered under the Companies Act 1956 or 2013, engaged in the business of loans and advances, acquisition of shares, stocks, bonds, debentures. How do they differ from our usual banks? Banks are allowed to accept demand deposits. NBFCs are not. So they will accept term deposit or any other specific scheme is if prepared by the central government, right? But again, NBFC will not include any institution whose principal business is that of agricultural activity, industrial activity, purchase or sale of any goods. So the prohibited business clause applies to the NBFCs as well. Then in the first unit itself, we studied about the Department of the Non-Banking Supervision of the RBI. It is entrusted with the responsibility of the regulation and supervision of NBFCs. So, what is the focus of this DNBS, Department of Non-Banking Supervision? Depositor protection, consumer protection, and financial stability. All right. Again, every company who is registered, if they want to carry on the business of the NBFC, first they will have to get a license from RBI to commence or carry on the business of non-banking financial institution. So they will have to obtain a certificate of registration. Also, they should have the net owned fund of rupees 25 lakhs or any other amount if specified by RBI not exceeding 100 crore rupees. So these two things, if fulfilled, they can act as NBFCs. Now coming to the most important point, NBFCs are required to get a license from RBI, but there are certain exceptions. Certain categories of NBFCs which are regulated by the other regulators, like venture capital fund, merchant banking company, stock broking company that are registered with SBI. They already have registration with SBI. They need not apply for a license with RBI again. Insurance company that has a valid certificate of registration by IRDAI, the Insurance Regulatory Development Authority. Nidhi companies under the Companies Act, chit companies under the Chit Fund Act, housing companies, NHB, stock exchange, or a mutual benefit company. So these companies, they already have a registration, a valid registration. They are regulated by the other regulators. They need not apply with a license to the RBI. Why? Otherwise, it will lead to double regulation, dual regulation, and too many terms and conditions to follow. So please remember these exceptions. All right. So those NBFCs who are already regulated by the other apex institutions, other regulators, they are exempted from the requirement of registration with RBI. Okay. And then we have the revised scale based regulatory structure. We have four levels of NBFCs: base layer, then we have the middle layer, then we have the upper layer and top layer. Upper layer and top layer. Again, important topic: which NBFCs will be included in which layer. The base layer will have the non-deposit taking NBFCs whose asset size is below 1000 crore rupees. Other than that, NBFC peer-to-peer lending platform, NBFC account aggregator, non-operative financial holding company, and NBFCs that are not availing any public funds or not having any customer interface. The institute will directly ask you which of the following is included in the base layer. So you'll have to remember these things. Which of the following is not included in the base layer? So they might give you a non-deposit taking NBFCs that have the asset size of rupees 1000 crore and more. So this you need to remember. All right. So these NBFCs are there in the base layer. Then in the middle layer, we have all the deposit taking NBFCs irrespective of the asset size. Doesn't matter what is their asset size. If it is a NBFC that is accepting deposits, it will be placed in the middle layer. Also, the non-deposit taking NBFCs that have the asset size of more than 1000 crore will also be put in this layer. Less than 1000 crore in the base layer, more than 1000 crore in the middle layer. Apart from these two, all the stand-alone primary dealers, infrastructure debt fund, core investment companies, housing finance companies, and the infrastructure finance companies. All right. So, which NBFCs will be there in the base layer and which NBFCs will be there in the middle layer? Very, very important. Do remember. You don't need to remember anything like what is the function of the core investment company, what is the function of the peer-to-peer lending platform. Nothing. Just the names. Just the names. And then we have the upper layer and top layer. Those NBFCs that have a very high risk level, RBI has said that they need enhanced regulatory requirement based on a set of parameters, scoring methodology. They will be placed in the upper layer. So these are what? These are scale-based regulatory structure or risk-based regulatory structure. So those NBFCs that are undertaking a lot of risk, specifically identified by RBI, will be put in the upper layer, and automatically top 10 eligible NBFCs in terms of their asset size will always be there in the upper layer. So any of these NBFCs that have that are placed in the top 10 in terms of their asset size will automatically move to the upper layer. And then finally we have the top layer which typically remains empty. Any NBFC that was earlier in the upper layer and RBI has said that there's a substantial increase in the potential systematic risk, then it will be shifted to the top layer. So base layer, least risky NBFCs are there. In the middle layer, a little more risk. Upper layer, the top 10 NBFCs in terms of their asset size, and top layer, systematically potential risk is there in the NBFCs that were earlier in the upper layer will be shifted to the top layer. Otherwise, the top layer will remain empty. All right. So make sure that you remember all of these, all four layers. Other than this, nothing else is important. RBI has given some revised references to the NBFC non-deposit base layer, middle layer, the NBFC non-deposit taking that have substantial or risk will be treated as the NBFC base layer. Okay, not important. Capital guidelines are also there. The internal capital adequacy assessment process should be conducted. A thorough internal assessment of the need of capital with regard to the risk in the business. Then pillar 1 capital is there, which is important, compulsory. Pillar 2 is a cushion. Realistic assessment of risk should be done by the NBFCs. Internal capital assessment according to the credit risk, market risk, operational risk, and then accordingly they should maintain the provisions. This has been identified by RBI. They will maintain a common equity tier 1 capital to enhance the quality of regulatory capital. Leverage requirement is also there. Differential standard asset provisioning is also there. Like we have studied about the different NPAs, how much provisioning is required for the doubtful asset class, how much provisioning is required for the substandard loss asset. Similarly, differential standard asset provisioning is there for the NBFC upper layer because the upper layer is more risky. And regarding the co-lending model between the banks and NBFCs, there should be a board approved policy. This board approved policy will be placed in the bank as well as the NBFC's website, so they can mandatorily take their share of individual loans originated by the NBFCs. If you remember, we have studied that in a loan, the maximum that holding or maximum share that the bank can have is 80, and minimum the NBFC should hold 20% of it. All right. Proper due diligence should be taken subject to specific conditions. And we are done with our unit 6 also. We are left with unit 7. I think we should stop here now. This one unit we will cover tomorrow in the second lecture, and then we will start with our module B. All right. After this, because you'll be having your capsule batches, demo classes for your elective papers. All right. So let us stop here and we will continue tomorrow. Till here, I hope everything is clear. Again, I will repeat, module A is on the fourth number of our priority, and only theoretical mugging up rote learning is required in module A. The sections that I have specified, the points that I have highlighted, just keep your revision limited to that. Nothing more than that is important. Okay, so don't worry about the revision, don't worry about any topic that you will. Yes, I will upload the PDF of the class. The PDF will be available after the class is over. You will also get the recording of the live session. All right. So now I will meet you at 7 p.m. on the YouTube channel of Olive Board English Medium, and we'll be discussing the questions. We'll be practicing the questions on YouTube, 7 p.m. to 9 p.m. And then from 9 p.m. to 11, I will meet you here on the paid platform and we will start with our module B. So those who are attending the class on YouTube, if you haven't yet joined the capsule batch, please enroll yourself and start with your preparation. Okay, so I'm ending the session now. Thank you so much. After this, you have your capsule class for the elective paper. You can join it. Okay, so thank you so much. Take care and all the best. Download the PDF, go through the notes and revise it. Do give me your feedback about the class. Thank you and all the best.